Now, Gugulethu recently sat down with Sias Esterhuizen, who's Chief Risk Officer at ECIC, to find out about the role of risk mitigation in the current macroeconomic and political environment.
Risk is core to our business. Obviously, as an insurance company, that is what we're here to do. That is why clients bring us as part of their portfolio in terms of helping them manage the risk in the business that they're doing. So for us, we've got a research and political and economic team that constantly monitors what's going on in all of the countries, not just necessarily Africa. So we currently have a good pulse on what developments there are and what the reasons are for those developments. And some of them might just be media hype, but we would have the insights because our teams do regular visits, country visits.
Wow.
And they speak to key individuals in those countries to understand what is behind the scenes, what are the governments doing to alleviate some of the concerns that's in the media. So it does mean we don't rely necessarily just on media for us to get information. We do visit the countries and key individuals. Yeah, and from a risk point of view of the ECIC essentially have got, we can call it 3 key activities, be it underwriting of insurance business. To underwrite that business, we have quite a large investment portfolio to support that underwriting function. So we need to make sure that our investment activities, there's sound risk principles applied there as well. And then normal operational activities within the organization. So if we delve a bit into the underwriting risk, which is where a lot of our business is currently in Africa, and our largest exposure is the mining industry in Africa, which is roughly, our exposure roughly currently is about 11 billion rands. Which consists about 36% of our overall portfolio. So it's a large proportion of our risk. So it does mean we are continually monitoring that sector and understanding what's happening there. And in doing that, the portfolio team that manages that has got a close working relationship with the financing institutions that finance a lot of those projects. So it means the guys go on project due diligence visits with the financing institutions to understand how's the project performing, where the guys are struggling. And specifically for mining-related projects, it would be a liquidity issues where, because of the commodity prices where it is today, the guys there might be liquidity constraints in terms of servicing their loan facilities. And so then, obviously, we try and support them as far as we can in terms of amending the loan facility or providing additional liquidity to the project. Obviously, that's within bounds in terms of what capacity does the ECIC and the lending institution have for that country or for that industry. Since for us, concentration risk is obviously a key thing in terms of to which countries or where's our concentration, which currently Ghana is a big concentration area for us. And monitoring that concentration level for us is key.
When it comes to the African continent, it's a little known fact that a lot of African economies don't default on servicing their debt in comparison to our peers in Latin America as well as in Europe. Does this work as a benefit when it comes to mitigating the levels of risk for South African investors who want to explore on the rest of the continent?
Yes, it surely does. So obviously we follow our clients in terms of where they want to do business, and that's where our exposure would come from. So we don't necessarily go and search out for specific countries. But yeah, you're correct in saying that we haven't seen any defaults from African countries, even though those economies are under strain due to they being very commodity-driven economies. But from us, we've seen that there's a lot of resilience in terms of those various industries where an entity would go to various lengths in terms of to make a project still viable. So yeah, so the projects we're insuring is linked to the country's default risk, to the extent that a lot of the projects are financed by government entities, which would then obviously rely on that government's balance sheet to repay the facility. But yeah, it's a project-led, so it's financed through the project generating sufficient liquidity to service the project. So it means that, yes, we are exposed to the default of that country, but it's a lot also linked to the project itself.